3 trillion plus per year deficits that we're now running are going to be fixed in place. They're not going to go away because they were only about an emergency. Now they're going to be basically that or more going forward because of demographics, which means the stuff we did that caused the dollar to lose 90% of its purchasing power since it became a fiat currency in 1971, we're still doing only on a much bigger scale. So we're making even bigger mistakes than the mistakes we made, which caused the currency to steadily lose value. And I think there's a good chance that the mistakes are of such a scale now that the slow and steady 1.5, 2% inflation rate of the past 30 or so years, or official inflation rate, is going to be much higher.
This week's specials with Miles Franklin Precious Metal Investments. 1,000-ounce silver bars for only $169 over spot per ounce, with 90-day free storage. And 2021 Silver Britannias for only $395 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend John Rubino from DollarCollapse.com. John, thank you so much for joining us today.
Hey Elijah, great to be back.
It's great to have you. And last time we had you on, we were talking about how it seemed like we were kind of coming out of the woods with respect to the COVID situation, and that, however, we've seen the rise of this Delta variant, and in the U.S., cases are rising quite a bit. And there's talk about, are there going to be further shutdowns and all of that? Your perspective on where the COVID situation stands right now.
Well, I think we were a little optimistic last time around when we thought it was basically going to be over, because we weren't counting on these, the mutation potential for this thing, and the willingness of the people in charge, or the eagerness of the people in charge, to shut things back down again. It's astounding to see how easily these guys slip back into, you're going to have to wear masks indoors and schools are going to be locked down, or we're going to wear masks. The 7-year-olds have to wear masks after they went through the hard year that they just went through. This couldn't have been fun to be a governor or a mayor in this kind of an environment, or the 2020 environment. But a lot of them seem to want to go right back into it, with a few exceptions. And I think that's kind of as far as COVID goes, I think that's the interesting story right now, where you've got some states who are not buying it. They're Florida and Texas, among others, are just saying, nah, we're not going to shut down the economy anymore. We're not going to go back to any shape or, any version of a lockdown. That's not going to happen. So we're going to run an experiment, apparently, where California and New York will go back to mask mandates everywhere and forced vaccinations, more or less, in a lot of cases, where they say, you don't get to work here if you don't have a vaccination. And Florida, Texas, and a few other states basically do the opposite. They say, just go back to normal life. We'll see how this turns out. And we will get to see how it turns out. And so far, it's looking pretty good, really, for the non-lockdown states, because they ended up in basically the same position as the lockdown states, without crushing their economies. But again, I'm not a scientist, so I don't have any right to an opinion about virus this or vaccine that. I'm just looking at it kind of politically right now and economically. So having said all that, we did take on insane amounts of debt to get through the 2020 lockdowns. And that debt is not going to go away. But what I think a lot of people don't get is that the emergency level $3 trillion deficits that we ran last year and that we'll run again this year are kind of the new normal, without a pandemic, because we have demographics now working in favor of massive new government spending. Because, my generation, the baby boomers, are retiring. And so we've got our hands out. We're saying, hey, okay, now we're ready for our free health care for the next 30 years because we're in such good shape. And, you got to pay us our Social Security with really legitimate cost of living increases. So all of a sudden, government expenses are going to go through the roof for demographic reasons, which means these 3 trillion plus per year deficits that we're now running are going to be fixed in place. They're not going to go away because they were only about an emergency. Now they're going to be basically that or more going forward because of demographics, which means the stuff we did that caused the dollar to lose 90% of its purchasing power since it became a fiat currency in 1971, we're still doing only on a much bigger scale. So we're making even bigger mistakes than the mistakes we made, which caused the currency to steadily lose value. And I think there's a good chance that the mistakes are of such a scale now that the slow and steady 1.5, 2% inflation rate of the past 30 or so years, or official inflation rate, is going to be much higher with some corrections along the way, with some little bouts of disinflation or deflation. But generally speaking, inflation is going to rise along with debt going forward. And that's a whole different psychological space. So that's my take, is that, the pandemic still could cause us a lot of trouble going forward, but you just want to add that trouble to the demographic issues that we've already got going, and try and figure a way out of it. And I don't see any way out of it. I don't see how to make the math work. So I think we've got rising problems going forward for a variety of reasons, none of which are fixable in the short or the long term.
You recently wrote about the demographic issues and with respect to baby boomers retiring and how this is actually going to be inflationary. And you just mentioned a bit about that. If you could expand on that, because some people see this as deflationary, but you made a good argument that this is actually going to be the opposite, inflationary.
Well, Harry Dent, for instance, is an analyst who has a very compelling case that retiring baby boomers are a deflationary force, which I think, it makes a lot of sense as far as it goes, because basically, a guy my age is, first of all, going to spend less than he did when he was raising his kids and buying new houses and things like that. We're going to tend to downsize and scale back as much as we can. And for the real estate market, that means a lot of McMansions going on sale with no real buyers, because who's going to buy, Elijah, are you going to buy a 5,000 square foot house anytime soon at today's prices? Probably not, if you're smart. And most people in your generation will not do that. So who's going to buy those McMansions? Nobody, unless the prices come way down. So that's a very deflationary dynamic. And that'll spread through the rest of the economy. And that makes a ton of sense. However, you then have to look at the response of governments to a big deflationary force out there, because we've already got one, which is the massive amount of debt we've taken on. That's very deflationary, because people have to pay interest on that debt that they could otherwise have spent on vacations and big cars and things like that. And a lot of people who borrowed money just flat out can't pay it back because credit terms were too easy when they borrowed the money, and now it's coming back to bite them, and they're defaulting, or they would default if they were left to their own devices, and that's deflationary. So we've got this thing going on already that is sort of like what retiring baby boomers will probably impose on the economy, and the government's responding to that with basically infinite money creation and unnaturally low interest rates. So if boomers downsize and cut back on their spending, and that's deflationary, the government will respond with negative interest rates instead of just zero interest rates, and $5 trillion a year of new money creation instead of just $2 or $3 trillion a year like now. It's all play money to them. They will just ramp it up as far as they need to. In other words, add as many new zeros on their computer screen as they have to, and then hit send. And so we'll see the money creation machine, the printing press, just go into overdrive, or another level of overdrive from today's overdrive. And that's inflationary. So you got these big forces out there, basically. Demographics are negative or deflationary. Money printing is inflationary, and we'll see who wins out. I kind of tend to think that the infinite force, which is money printing, because they can make as many new dollars as they want to, will win out over the big but finite force of boomers retiring. So that's my guess going forward. And I think history bears it out. You've seen countries throughout financial history make the same mistakes we're making, and they always end up with massive deflationary or inflationary booms, which is what we will probably get going forward.
Now, you mentioned the real estate market, and we actually have a few viewers' questions I'd like to ask you. One of them is about the real estate market. This viewer asks, what impact will the current reverse repo explosion have on the housing real estate market?
Well, to the extent that it keeps interest rates low, that makes mortgages easier to get and makes home prices, other things being equal, higher than they would be. So, yeah, and any kind of additions of liquidity to the market are good for real estate in the short run. In the long run, we've already pushed prices up to the point where they're not affordable, even at today's mortgage rates, for most people. So we're in the realm of unaffordability right now. So it's not clear how much further you can push up real estate prices, but in a vacuum, any kind of liquidity addition on the part of the Fed is generally good for real estate. But I think there's a point at which nothing helps, and I think we're heading for that point with real estate. So I don't know if there's anything we can do to keep home prices going up from here, just because nobody's incomes are rising commensurately, and you reach a point where nobody can, qualify for a loan based on their income if the price of the house is beyond a certain point. So, I'm not optimistic about the real estate market going forward, but I think to the extent that the government's shoveling liquidity out the door, it helps rather than hurts.
Definitely. And this viewer is wanting to know, if you're not as bullish on real estate, what are the assets that you are the most bullish and also bearish on right now?
In a inflationary period, which is to say a currency crisis, which is probably what we're headed for, real assets do well. That is, things that don't depend on the value of the dollar for their utility. In other words, a nice piece of farmland is going to be able to basically do what it does, regardless of where the dollar index is and where, short-term interest rates are. You're still going to be able to make food on that land, and that food is going to be valuable because we're going to continue to eat, even if we don't do anything else. Eating is what we will continue to do. Gold and silver, real forms of money that have been around for 3,000 years at least, and have every single time a country screwed up its currency, held their value. In other words, they've done well in inflationary periods since the days of the Roman Empire. So there's no reason to think that they will behave any differently this time around. They're just as rare as they always were. Their supply is increasing at basically the same rate it always has, which is to say 1 or 2% a year. In other words, not far from population growth. So you would think they would hold their value going forward, and whatever kind of purchasing power you put into gold and silver will still be there later on. Now, having talked about real estate, there's one part of it that might, other than farmland, that might still be valuable, and that's a really well-chosen rental house. Because in times of turmoil, when people can't afford houses and maybe get thrown out of their houses, like what is coming with this, the wave of foreclosures that apparently we have heading for us this year, they still have to live somewhere. So rental properties become pretty hot, and they become something that you can generate cash flow with in that kind of a market. So a really well-chosen rental house. And then by that, I don't mean a condo in Miami or San Francisco or someplace like that, in bubble markets, someplace like a college town where prices aren't already through the roof and where the economy is kind of stable. Someplace like that is probably where you can find rental houses that will hold their own through a currency crisis. So basically, the concept is real assets versus financial assets. Now, the financial assets, which will do very badly if the dollar starts to fall in a dramatic way from here, would be anything that depends on the value of the dollar. And that would be government bonds, which pay you dollars month after month or year after year, and therefore depend on the value of the dollars they're paying you, and bank and other kinds of financial stocks. Banks basically depend on the value of all the currency and debt that they hold, right? So they will tend to do badly if we enter a period of dramatically higher inflation and a dramatically lower dollar. And banks don't do well in deflation either. So kind of whatever comes now is not a good thing for the banks, I think. So bank stocks, short the bank stocks, just like you could have done in 2007, if you hop in a time machine and go back then. You wanted to short the banks. You wanted to short government bonds, at least for a little while. And you would have been protected from the financial crisis that ensued. Actually, I'm wrong. Sorry, I said short government bonds, and you didn't want to do that back then, but you probably want to do that now, because what we're having now is probably a sustained period of inflation that will make bonds less valuable. So yeah, financial assets. And last time around I shorted the home builders because houses being financial assets had been bid way up. And that worked out. So that might also work out again if you count the home builder stocks as financial assets. In other words, because what they build is financed when it's bought, you might do well too. So things like that. So avoid anything financial, jump into anything real, and you'll probably do well pretty much whatever comes.
This viewer is wanting to know about the consequences of lockdowns on inflation. So I know last time when we saw, lockdowns across the board, the first time we saw that, money velocity plummeted, and that obviously has an impact on inflation. So your perspective, if we continue to see lockdowns in kind of like isolated areas, will that have any impact on inflation?
Yeah, this is another one of those things like the demographics trends that we talked about, where a lockdown is wildly deflationary at first because it basically shuts down the economy. If you shut down all the restaurants and the bars and nobody goes into stores, those parts of the economy really crater. However, you have to also look at the response of governments to lockdowns. Say they lock us down again this year, but they also come out with a bunch of new COVID relief plans of various kinds and push interest rates down even further. Then you have to think, okay, which one is the bigger force? And we can't know that ahead of time, but it's completely possible that government's response to the effects of their lockdown will be bigger than the lockdown itself. And so it'll actually be inflationary in total, which it kind of was this time around, right? You had a little spike down in inflation. So we had a little bit of deflation early in 2020. And then we went right back to rising prices after the government handed a bunch of money to people and bailed out a bunch of corporations and printed a lot of new currency and dumped it in the banking system. And there's no reason to think they won't do that again, because, see, they think they've learned the correct lesson from this, which is you always counter any kind of an economic slowdown or other type of crisis with easy money. You just overwhelm the crisis, and then you get back to quote unquote normal. But what actually happens is that you get back to top line number normal. In other words, inflation goes back to something that's in your range of acceptability, and unemployment goes back down. But you do it with a massive amount of new debt that you took on to counter the crisis. So you're more vulnerable to the next crisis. And what we've done for the last 30 years is basically that over and over again, going all the way back to the days of Alan Greenspan bailing everybody in sight out at the Fed. So we've ended up with so much debt now that we're super fragile. Any kind of a crisis, like take, for instance, a normal bear market in equities, a 20% drop in equities. We might not be able to survive that financially now. Something that garden variety and that common might be so dangerous for the financial system that it would cause mass bankruptcies and lots of other dominoes to fall and push us into a 1930s style depression or a Weimar Germany hyperinflation or some kind of a crisis that would seem way out of proportion to the initial problem. So governments can't even let that happen anymore, because they've taken on so much debt in the past. If the stock market drops by 10%, the plunge protection mechanism would jump into action right away. Interest rates would go down, money printing would go through the roof, bailouts would happen all over the place, just because they know they can't handle normal crises anymore. So that's where we are now. And eventually that blows up on you. You find a crisis that's too big to bail out, and then everything falls apart. And that's a very real danger out there. And we've created that danger by making so many stupid mistakes year after year and decade after decade in the past.
This viewer is wanting to know, if they have a 401k or they have a 408M3, like how can they protect themselves in this kind of environment?
Okay, there are two things with all these retirement accounts. One is it depends on what you're invested in within your account. If you have a bunch of, say, growth stock funds in there, you have done great. You probably doubled or tripled whatever you put into it in just the last couple of decades. So congratulations. But that money is at extreme risk in the kind of financial volatility that's coming. So, you're basically at risk of giving back all of the money that you made. On the other hand, if you're in really conservative stuff like extremely short-term government bonds, which are a very common kind of fund in a 401k, then you're not at risk of market volatility, but you're at risk of rising inflation because those short-term government bonds don't pay much interest. So they basically just depend on the value of the dollar. They're there to maintain your purchasing power. But if the thing they're using to do that goes down in value, then so does your purchasing power. So, the average 401k portfolio has done beautifully, but probably won't do nearly as well going forward. And I don't know if most 401ks allow you to invest in precious metal funds or commodity funds or anything like that. If they do, by all means, jump into those things and shift out of your financial assets. Now, the other problem with these investment accounts, these online investment accounts, is that the government is going to be desperate for money in the future. Yes, they can just create as much as they want to, but that's going to be politically more difficult as people figure out what it involves and the risks that it brings. And so governments are going to be looking around for other places to tax you or to confiscate your wealth or whatever. And the investment accounts that are out there now, the retirement accounts, are a multi-trillion-dollar pot of gold for these guys. So I don't think it's unreasonable to hedge against government confiscations of investment accounts. Well, actually, there's a third issue with these things too, which is they're online. If you've got money in a brokerage account that's online, you're at risk from cyber war, from solar activity, from EMP attacks. There are lots of things that can take down the internet, none of which are highly probable right now. But if you add up all the small probabilities, you get a fairly decent probability that one thing like that will happen, that the internet will be disrupted for a longer time than seems reasonable right now. And if you can't get to your 401k or your IRA, then that's also a big risk that you need to consider. So what you can do about that is, if you're able to move money out, in other words, if you're retired and you've got a 401k, you can take money out without huge penalties and just pay the taxes on it, and then maybe move it into real assets that you hold in hand, gold and silver coins that you've got at home, or that real estate that we talked about, whatever, things like that, to eliminate or mitigate the risk of having these online accounts full of mostly financial assets. That might be a thing to do at this point. I know it's inconvenient, but it would be much more inconvenient if you either couldn't get to your money or the government started just siphoning a bunch of it away or whatever. So the days, to put this in a bit broader context, the days of very easy investing are over. When you used to be able to just do the 60-40 stock bond mix, put it in a brokerage account online and just watch it go up. That was fun in retrospect, but those days are kind of ending. It's going to get much more complicated and much more tricky going forward. So you have to take steps beyond the old easy way of doing it if you want to protect yourself going forward.
Definitely. And if anybody has any questions about how to invest in precious metals, like, for example, in their IRA, that's actually possible. And you can just call us right there. It should be the number on the screen right there. Just ask any questions about that. But what I did want to ask, one last viewer's question. The viewer asks, what is the status of pension and hedge fund managers adopting some allocation of precious metals? What forces are preventing them from doing this?
Well, the thing that keeps mainstream money managers from buying precious metals is, one, they've never paid any attention to it in the past. They didn't learn about those things in business school, and they have not invested in them professionally. So they're kind of alien. The second thing is Gold and silver bullion do not pay any kind of interest, so there's no cash flow to point to there. And most of the financial models that you use to decide whether to invest in something focus on future cash flows. For instance, you buy Apple stock, you're going to get some dividends, and those dividends are liable to go up as earnings increase in the future. So you can kind of, you do a regression analysis, get it back to a net present value, and that allows you to put a value on today's Apple stock. You can't do that with gold and silver because their cash flows are zero going forward. And what these guys miss is that gold and silver aren't competing with Apple or Google stock. They're competing with dollars and euros and yen. They are money. And so the question becomes, which kind of money will hold its purchasing power over time best? And clearly that's gold and silver right now. Precious metals will hold up better. They have held up better, and they will hold up better going forward. So if you're looking at a cash balance that doesn't pay you any interest, you might as well have it in precious metals, a form of cash that will hold up better than your dollar cash. That idea is still kind of alien to most institutional money managers, but as gold and silver continue to do okay, they get a lot of clients asking about it, and they feel that pressure when somebody calls them up and says, what, gold is up from $200 and some at the beginning of this century, and now it's $1,800. Why don't I own any of it? I know I shouldn't be in 100% in gold, but shouldn't I have some? And the money managers hear that and will respond to it over time. So I think more and more of them are right now looking at some kind of a precious metals related investment. For instance, what might get them into it is the fact that the mining stocks, the gold and silver miners, are putting up good numbers because gold and silver are at prices that make a lot of money for most of the big gold and silver miners, which means you've got free cash flow and they're raising dividends and their earnings might go up in the future, and which means net present value. You've got cash flows you can extrapolate into the future that way. And so the gateway drug for a lot of mainstream money managers might be the big gold and silver miners, which will get them interested in precious metals in general, and maybe you see bigger allocations out there. No guarantee, but that's likely to be the way it plays out, I think.
Fantastic. Well, John Rubino, we really appreciate your insights today and your time. Before we let you go, did you want to share with the viewers any last thoughts you had and where people can find your work online?
Well, yeah, I run dollarcollapse.com, and there's a tab at the top of the site that says join our email list. So if you click on that, put your email in there, and whatever I write personally on that site, I'll just send to you for free. And we don't use your email address in any other way. No, don't sell it to advertisers or anything. So it's just the stuff that we publish coming into your email box.
Fantastic. And if people would like to hear more of these interviews, hit the subscribe button on YouTube and the bell icon, or you can go to libertyandfinance.com and sign up for our free newsletter. John, once again, thank you so much for your time, and God bless.
Thanks, Elijah.
This week's specials with Miles Franklin Precious Metal Investments. 1,000-ounce silver bars for only $169 over spot per ounce, with 90-day free storage. And 2021 Silver Britannias for only $395 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.